Hello everyone, welcome to Module 2. This module is about market movement, balance, imbalance and gaps. And this is going to be quite a long module, going to be quite heavy. There's a lot to talk about here and it's a very important module. So we're going to need to pay attention. You might want to watch this one a couple of times. I'm not quite sure how long this is going to go on for, this particular module, because there's quite a lot of information to cover. So if it ends up going on for a long time, I might split this down into two separate modules, but we'll see how we get on. Okay, so what we're going to cover in this module is how the market moves and why it moves. Okay, so the market is basically made up of buyers and sellers. It's just like any other market. So I'm going to quickly explain what a market is, which is pretty obvious, but I'm going to show you how it works in respect to Forex trading and trading in general. The big banks, I'm going to talk about the big banks and who actually moves the market, what's actually going on behind those candlesticks that you see painted on your charts. The stop hunt, which is basically the power that moves the market that the banks use to make their moves and manipulate the market. The market efficiency and the footprints of inefficiency, which help us to pick targets and look for areas to trade towards. And we're going to cover levels theory and the 3-level push. So as you can see, there's quite a lot to go through here. It's going to be a fairly heavy section, as I say. So you may want to take a break, go and get a coffee in between bits, pause it, whatever you want to do. Take some notes on this section. There's a lot of stuff in here that is going to be quite key that you're going to need to note down as well. All right. So first of all, let's have a look at what a market is. So the market is made up of buyers and sellers. So whenever you have a transaction in a marketplace, whether it be a fruit market where people are buying and selling bananas, whether it be eBay where people are buying and selling second-hand goods, Amazon is a market, any shop is a market. Basically, they have products that they are selling and you are a buyer. Wherever you see a market, there is a buyer and a seller. And for price to be able to move up and down within that market, i.e. paint candles on your chart for a particular currency pair in this case, there needs to be an imbalance of buyers and sellers. So all the time that we've got happy buyers and sellers in the market, what you'll see price doing is moving like this, okay, as people are buying and selling and happy to conduct their business at that particular level. When you get to a point where there's more supply than there is demand, what you tend to find is the sellers will start to reduce the price of their product to entice more people to buy it, which will then take them to another area where buyers and sellers are happy to conduct their business. Then you'll get another point which will come along where there will be way more buyers than there are sellers. So there is a demand for a product or a service and there's not many people supplying it. So therefore they put the price of that product up and they can charge more for it until it gets to a point where there's an equilibrium again with buyers and sellers. Okay, and this happens in all walks of life. As I say, it happens in markets, everywhere you go. Whenever you're buying or selling anything, you're in a marketplace. Okay, and this is what you need to think of when you're thinking about the Forex markets or the stock market or any market indices you want to trade. Okay, so the market is conducted with buyers and sellers and it's driven by supply and demand. When there's more buyers than there are sellers, price will shift in one direction. When there's more sellers than there are buyers, it will shift back in the other direction. And it will continue to do this all the time as long as people are looking for a fair price to trade at. Okay, so let's look at who actually moves this market. All right, the market is mainly run by the big banks. Now this is a $7 trillion a day market, the Forex market. All right, you and me as retail traders cannot move this market in any way, shape or form. All right, The market is moved by big banks and institutions, and their job is to build a book of orders, buys and sell positions in the market until they have a balance, or an imbalance rather, of orders on their book, and they need to move price to a new area so that they can take a profit, and then they reset. Okay, I'm going to explain a little bit more about how this works with a slide in a minute. Okay, but this is partly why price has what's called an ADR, okay, which is an average daily range. Now we're going to look at indicators a little bit later on in another module, and the ADR is a very important indicator that I use because it shows you what the average range of an instrument will move within a specific day. Okay, so the market makers, as they're called, or the banks, the institutions, these big guys with all this money to pump into the market, which is going to make it move, these guys have a certain distance they can take price in a day before their books are filled with profit and in balance, so that they can't take it any further. So this is what is represented by the average daily range. We're going to use this to our advantage with one of our entry strategies, and we're going to trade when the average daily range is exceeded, but I'll talk about that a little bit more later on. So when their books are balanced and they've got their profit, it's not profitable for them to continue to push price in one direction. So what tends to happen is then they reset price, which is what we would class as a balanced area or a consolidation. And there they build more orders, more buys and sells, and then they just repeat this process over and over and over again. All right, and this is how they make their money. Now, if you think what investment banks and foreign exchange desks on banks are, they're basically just transactional desks for their customers. So, for example, someone like Microsoft may want to do a transaction with Saudi Arabia, for example, and that transaction will be carried out in dollars. So what the Microsoft guys will do is say to their bank, whoever their bank is, Barclays or NatWest or whoever it is, Citibank, doesn't matter who the bank is, they'll say, I need to do a $100 million transaction. I want you to go out and get the best possible rate for me. And what that desk will then do is it will sit there with an order to put into the market to change $100 million into whatever currency to make that transaction happen. So they know that when they dump that $100 million into the market, what's going to happen to price? They're pushing price in one direction or the other, depending on what currency is being injected into the market. Now, the fact that they know that they've got a massive order there that can drive the market in one direction or another, do you think they're just going to sit there and put that in one go, or they're going to use it to their advantage to make money? Obviously, they're going to make money. So the investment banking desk will be sitting there going, right, well, we need to make money, so we need to buy or sell at a particular price, make a profit on it when it gets to another price point. Okay, so let's say the bank is sitting up here at this price. They know they've got a massive order which at some point is going to push price down. What are they going to do? They're going to build a book here with loads and loads of orders, but they're going to make sure that at one point in time they are net short. Okay? What that means is in this period of consolidation, which we'll have a look at in a minute, they will be buying here, selling here, buying here, selling here, buying here, selling here, and continuing to do this over and over and over again until they've got, say, 10 million longs and 15 million shorts. Okay, so they are what's called net short. They've got more shorts than longs. So if the market goes down, they're going to make the difference there, roughly. I mean, the maths isn't really important. What's important is you understand what's happening behind the scenes. Okay, so this massive order comes into the market and all of a sudden price moves down. What they'll be doing is they'll be taking their little bits of profit as price moves down, okay, getting out of these short positions, further down until they get down to a point where they go, thank you very much, I've made my 5 million. That's it, I'm done for the day. Okay, and then the price will usually go into a consolidation, or it will be handed over to another desk where they will decide what they want to do with it next. But what they're left with is a load of long positions. So what you tend to find happens is once the market has moved down, it will then need to do what we call a retracement. And that retracement is the bank dumping all these longs and making profit on them as they go up. And then they reset, start the day again. Okay? That in a nutshell is kind of what's going on behind the scenes. Obviously it's a lot more complicated than that. There's algorithms at play and all sorts of things. But the basic principle you need to understand is that you have no control over what's happening in the market. The market is controlled by what conditions the big banks and the big institutions that have enough volume of orders to make price move. It's what they decide is where the market is going to go. Okay, so what you need to do is try and identify the footprints that they leave behind and look at historical information about what they've done in the past to see if we can figure out what they're going to do in the future. And that's partly what I'm going to be teaching you throughout this course, is to understand how these banks and institutions are manipulating the market and how we can take advantage of those by looking at certain conditions that arise over and over again so that we can profit from their moves and basically get on the trades that they're going to be taking. Okay, so to demonstrate this in a little bit more detail, I want you to meet Bob, John and Bill. And these guys work at Barclays in London, Singapore and New York. They're basically on the investment desk there. And these guys are who entice you to take trades. And these are the guys that stop you out and then they move away with your money. These are the bad guys, okay? These are the guys that trap you in your trades. And have you ever wondered why when you take a long, all of a sudden it goes the opposite direction? Because you're trading against these guys and they know exactly what you're going to do as retail traders, all right? So these are the guys that trap you in a bad trade. They make you sweat, they break you, and then they move away in the direction that you originally thought it was going to be, but they've already taken your stop and you've lost the trade, you're getting angry. Basically, this is the enemy, all right? So let's have a look at what Bob, John and Bill do. We'll start off with Bob. Bob works in Singapore, okay? He's on the Asian desk. Now there's 3 sessions in the day. We've got the Asian session, the London session and the New York session, all right? And each of these has a guy working for the bank. In this case, we're talking about Barclays. This is completely fictitious, of course, but basically Bob sits on the Asian desk and his job is to accumulate those buys and sells, all right? So you can see Bob's sitting here in Asia, and what he's doing is he's taking price up, taking it down, taking it up, taking it down, up, and he gets up to here. So he's done some selling, he's done some buying, some selling, some buying, a bit more buying, and he's now up in this position here. Okay, so what's he got? 1, 2, 3, 4, 5, 6 orders, let's say. All right, so he's got a load of orders basically on his book, and what he's going to do is when it gets to the London Open, he's basically going to say to John, okay, I got 15 million shorts, 10 million longs, I'm net short. John, over to you. Do what you will with it. Okay, and what John's going to do basically is look at the book and go, okay, well, I've got loads of orders here for loads of people to place. What I'll do is I'll place a load of short orders now. I'll split this 200 million of shorts I've got to put into the market into 500 orders, and we'll gradually take the price down. So this big book that's been handed over to John with all this net short in it, basically what he's doing in the day is he's taking it short, getting out with all of his profit. Okay, so as I've written here, London opens, Bob hands over to John, he says we're net short, take it down. John says no problem, manipulates the market with all the large orders, and when he's moved it far enough, he cashes out and passes over to Bill. All right, these blue lines here are indicative of what we call the average daily range. All right, and you can see how price hits the average daily range and bounces off of it, and that's because he can only move the market so far with the orders that he has before it doesn't become profitable for him to move it any further. Okay, so his book is complete, if you like. So John's finished for the day. New York starts. He passes over to Bill. Says to Bill, Bill says, how's the order book looking, John? John says, well, I took it short, made 1.5 million, and I've got net longs left now. No problem, says Bill. I'll take it up and pass it back to Bob in the morning once we've got the profit. See you for the handover tomorrow. All right. So his job now, he's got a net long book down here. His job is to take price higher, get out, take his profit, bring price back, start building a little bit of book before passing it back over to Bob. Restart Asian session. Same thing happening all over again. Building a book in consolidation. Passing it over to John. John takes price in one direction. Now this just happens to be 2 downward London sessions day after each other, but obviously depending on what this book is when it's passed over, this could be John taking it off in that direction. We don't know. Okay, but you get the idea basically. This is what's happening behind the scenes. This is why these candlesticks are being painted. It's not because you've taken a short up here. I could take 1 million shorts up here and it wouldn't move the market an inch. Okay, we haven't got the liquidity needed and the number of orders needed to actually make this thing move. This is what the banks are doing. Okay, so that's the banks basically, and that's kind of all I wanted to cover on them. There's loads of information out there about the banks and the forex market and how they work, but the thing you've got to take away from this particular section is that you have no control over this. All right, there are people manipulating this market, whether it be intentionally or unintentionally, by just the sheer volume of orders that they have to place into the market. And all we can do as retail traders is jump on the train with them and join them on their journey. And what our job is to identify what these guys are doing by the patterns they leave in the market. All right. So there's certain things that we will see happening during these sessions that will give us a clue as to whether they're going to take the price long or short. And there are certain entries that we can take, which we can trigger at certain times to make profit. And that's basically what we're doing on a daily and a weekly basis. We're following these guys in the market. Okay, so let's have a look at the next slide. The stop hunt. These banks need to build up power. They need to build up orders in order to make moves. And one of the main ways they do this is by taking your stops. Okay, so as retail traders, we are taught when price gets to a certain level, okay, and we see that we want to be taking a long, so for example, let's say we wanted to go long there at this level, we're taught as retail traders, when we enter this trade, we put our stop under the most recent low, okay, or this one, could be, doesn't matter, whichever, doesn't matter, this is a fictitious trade, but you'd pick a low to put your stop under, all right. And then price is either going to carry on its merry way, we're going to take a profit, or it's going to come down and it's going to stop us out. Okay, and those are the two outcomes that we've got as traders. The banks know we're putting our stops here. It's obvious. This is what we're taught. This is what everybody does. Okay, so they know that there's a load of orders sitting at these levels, under these lows, and over the top of these highs. All right. And that's because that's the logical thing to do. We're taught to set a stop loss, a physical line in the sand that will protect our account if price goes the wrong way, i.e. if we're wrong on our trade. Okay. So because they know this and they have the power to manipulate price and move price with volumes of orders, it's very easy for them to come and take our stops out continuously. All right. Common levels that this happens at are the highs from yesterday and lows, the weekly highs and lows, and the previous day before yesterday's highs and lows, which I'm going to show you on a chart in a second. And there's also other turning points on higher time frames, support and resistance levels that have previously been respected, that there will also be stops at. Okay, so the market will tend to be drawn towards these stop levels or areas of liquidity, or where there's a lot of orders sitting, so that it can gather those orders before moving off in the opposite direction. Stops are the power that the market uses to change direction. All right. So what we can do is use this information to see what happens at these levels, and that will give us clues as to whether the market, the bankers, are deciding, yep, we're going to make a turn here, or we're going to push straight through this and carry on. All right? And we're going to look at some examples of those on the chart in a minute. The important thing to understand is that trading at these levels, or just after these levels have been tested, bounced off of, or swept, is what gives you an edge in the market. If you were to take any pair that has been ranging for a day, a week, a month, whatever the time period, could be half an hour if you're trading on 5-minute charts. If you've got a range which is clearly defined on a chart, it makes absolutely no sense to take trades in this middle section here. Okay, you can see that price is moving up and down between certain levels. So what these typically are going to be stop hunts. This is a really bad example of a drawing, so I'm just going to rub this off and draw something that makes a little bit more sense for you. Okay, so let's say price is moving like this. Okay, comes down, moves up again, comes down, makes a new low, moves up, consolidates a little bit, comes back up here. Okay, because the market's not going to hit exactly every level, but you get the idea. Okay. So what's happened here is the market has come up and taken out all the stops from the people that took a short there. Okay, so it's taken out these stops, and then it's turned around and it's moved back down this way. What's it done here? It's moved back down, it's taken out all the stops of the people that went long there. Move back up, move back down. What's it done? Taken out all the stops of the people that took along here. And it keeps continuing to do this over and over again. And it's powering itself up, building an order book, ready to make a move in one direction or the other, depending on how many shorts and longs it's managed to accumulate over time. Okay? And this is basically what the stop hunt is, and why it happens in the market. Okay? So these levels make logical sense for us to take our trades at, not trading in the middle of the range. This is what's going to give us our edge. We've got a good chance of price making a turn at these positions, these points. We've got an awful lot less chance than in the middle, because we don't know which way price is going to go, but we've got a much stronger idea of price moving away from these levels when we see ranges happening. Okay, so these can become both targets for us to aim for and entry points for us to trade away from. So when you're in a range, the ideal would be you buy here and you sell here, and price moves like that, and you just keep buying and selling until at one point you're wrong and price goes off in that way. You're stopped out. So you've made profit on these trades and you lost this one. Okay, so one of the things that you will see when we go and look at some charts in a minute is that these areas are key points where price will bounce from. But if one of these key points fails, i.e. if a stop hunt happens in the market and it doesn't come back down and it shoots off up in the opposite direction, what's going to happen next? Okay, so we've had this happening. Price has gone up. Okay, where's it going to go? It's got to go up to another area to find a stop hunt. Now what you might find is that back here we had this sort of movement. So what price is going to do is continue going up until it finds another level to stop hunt, and it's going to take these out before coming back down again. Okay, so if one point fails, i.e. you have a losing trade, what you're going to do is you're not going to take a trade again off in the same direction. You're not going to chase that trade. You're going to wait for it to get to the next level that looks like it might perform a stop hunt, and then see what price does there before moving back in the other direction. Okay, so let's go and have a look at some stop hunts on a chart. Okay, so we can see if we can make this make a little bit more sense visually for you. Okay, so let's draw some lines on the chart at areas that you may well have taken a trade at. All right, so let's say we saw this big down move here, okay, and then we saw price retracing up, and we thought we'll take a short the next time we get some kind of bearish signal or bearish candle. All right, so there's a nice big bearish engulfing candle here, so let's say we took a short there. All right, we would have put our stop just above that candle there. All right, in the anticipation that this big down move and pullback would then continue to go down. So what happened to price? Price moved along, consolidated, came up, took out our stop, and then pushed off back down in the opposite direction. Okay, how often has that happened to you? Yeah, happens all the time, doesn't it? Okay, so let's assume then that we saw that happen and we thought, and it's come back down with this big bearish engulfing candle there, and we thought, right, I was right, it is going to go down. So I got in again here, and I put my stop here, just above those candles again. Okay, price moves down, which is brilliant. Now I probably would have taken some profit down here. If I haven't, then yeah, I'm a bit crazy, because that's a massive risk reward. But what's happening is price is coming back up again, and it comes up and it takes out this previous high again with another stop hunt. And see how it reached for that big push, big what we call a propulsion candle, going through that stop hunt area before turning around and plummeting all the way back down again. Okay, and this is a typical thing that they will do, this candle. They'll use news events, things like that, to push price in one direction really fast. And all they're doing is, first of all, they are enticing people to go long. So when somebody sees this, a lot of the newer retail traders will be jumping in going, wow, it's flying up, look. They're getting up here, and immediately it turns around and crashes the other way and takes them out. It happens all the time, yeah? So basically, this big candle is just reaching up for these stops before gathering all that power and momentum up there and then pushing back down in the other direction. Okay, and these stop hunts happen on all levels. So let's have a look at some stop hunt levels on the lower time frames. We're going to look at M15 now. So the M15 chart is where a lot of the trading happens, and a lot of my entries will happen. So the reason I like the M15 more than M5 is basically M5 is a lot faster and a lot choppier and gives you a lot of extra signals which tend to get you stopped out. So what I want to show you is with the M15 chart, the levels quite clearly for Asia, London and New York, and I'm going to show you some of the typical stop hunts that happen. Remember early on I said I was going to show you some examples of the Asian session highs, yesterday's highs, yesterday's lows, last week highs, last week lows, and other levels in the market, so like the previous day's highs and lows. I'm going to show you those now so you can see how those get stop hunted on a regular basis during the London, typically the London session and the New York session. All right, so just starting with this chart here, the euro odd, prime example of stop hunts here. So we've got the Asian session, which you can see, this is my indicator template basically, which you'll be able to get from Telegram. So this is the Asian session drawn with the Asian session high and low. You can see how the market was pulled down after the Asian session, and we had this low put in here before moving off in the other direction. Now there's two ways stop hunts happened here. So Let me just get my drawing tools up, 1 second. Okay, so you can see that we've got this blue dotted line here, which is yesterday's low. Okay, and that's from this New York low there. So basically, at the Asian session, we handed over to London. London pulled the price down, took out the stops of everybody that has gone long in this bottom at London and this New York session low here, and taken price back up again in that direction. Another stop hunt that's happened here is we've got the Asian session low. Okay, they've also stop hunted that. So anybody that was in the Asian session and took an entry in the Asian session for a long could have used any one of these levels here, but typically the lows of the session, to take a long. So they came down and swept those as well. Okay. Looking at what happened in New York. New York opened up, saw the highs of the London session. Okay, so London was here, handed over to New York. New York opened, came up, took out all the stops of anybody that took a short position there in the London session, which was in itself a stop hunt of the Asian high. Okay, and then pulled price back down this way. Okay. There's good examples of some stop hunts there. Yesterday's highs and yesterday's lows are particularly good levels to look at. Let me just go back further on this chart and we'll just see if we can find some brilliant Asian session low stop hunt there, just spotted. There's the low of the Asian session. London brought it down. New York continued down. Pins through that low, took price off in the opposite direction throughout the Asian session. There's a high stop hunt here on this level. Okay, so we've got a level here. Why has that suddenly gone thick? 1 second. Let me get rid of that. Okay, so we've got a level here. Okay, price moved up through the previous days. That would have been the previous day's low, so they've been drawn from the bottom of this session here. Okay, they came back up, retested there, pulled back down. Try and find a good stop hunt of yesterday's high or low for you. There we go. Okay, so here is yesterday's low. All right, this is from the low formed here in the London and the Asian sessions. Okay, so price pulled up in New York, came back, consolidated in Asia. We had a lovely stop hunt of the Asian highs here. Price came down, took out anybody that on this move here had taken a long. They would have had their stops underneath these lows here. Came down, took out those stops, back off in the other direction. So all they're doing, basically, the banks, is they're moving from level to level. Wherever you see a level drawn, they're basically moving from level to level because they know that there is money there. They know there's money at these levels because people are going to be putting their stops there. So what they do is they just manipulate the market up to touch these levels, take them out, grab the money and run off in the opposite direction. Okay, so that's a stop hunt on the Asian session and on yesterday's highs and lows. The next thing we're going to look at is what I call market efficiency. The banks and the market makers like everything to be efficient when price moves. Okay, so price moves up and down, but it moves in a very efficient way. There are times in the market where there are inefficiencies created by the volume of orders that the banks and the institutions plough into the market. And these are incredibly powerful levels that we need to look for. So we're going to look at the charts in a second, and we're going to find lots of examples of these and how we can use these as targets for our trades. Now these have got many names, these inefficiencies. They're known as voids, FVGs, which was coined, I believe, by Inner Circle trader Mike Huddleston, fair value gaps, imbalances, propulsion candles. Lots of people call them all sorts of things, but basically what they are is a big candle and a big move in price in one direction. Okay, so let's first of all have a look at the efficiency of the market. I'm going to zoom in to demonstrate this. So the way the price moves is it likes to trade in both directions efficiently. Okay, so if you remember when we started this module, I spoke about the fact that this is a marketplace like any other, and to have a buyer you need to have a seller and vice versa. All these candlesticks are transactions happening in the market between buyers and between sellers. Okay, so when price moves down, okay, with these candles here, it needs to make sure that if it moves too fast, that these areas in this candle have all been efficiently traded. Okay, remember, the banks are building a book. They're doing this all the time, moving up and down, buying and selling, buying and selling, buying and selling, and building a book. If price moves up too fast, they haven't had a chance to do their selling here. Okay, because price moved too fast, they didn't get a chance as this was going up to do buying and selling and buying and selling and buying and selling and making profit. Right, so these are what we call the propulsion candles. When these happen, it creates what we call an inefficiency or an imbalance in the market. So typically what will happen is every time you see one of these candles forming, price will have to at some point come back and fill that area that wasn't traded in. Okay, these propulsion candles or imbalances are key targets that we will choose when we're taking our trades. So let's look at some examples of a nicely balanced trade and an imbalanced trade, or a nicely balanced and imbalanced candle, if you like. Okay, so I'm going to pick this one here because it's just jumped out to me as an obvious one. Price traded up here and then put in a down candle. Okay, you see this bottom of this candle here, right? How price moved down but didn't necessarily move back up and trade in this area. So what happened on the next candle is they reached up, made sure that this section between the open of this candle here and the open of that candle here was efficiently traded, and that's what this wick is. All right, again, you see the wicks coming up. Every time we see an area where price moved down quickly, price tries to come back up and fill this gap. Okay, it reaches back up. If it can't make it, and the selling pressure in this case is too high, what we've created is what we call an inefficiency in this candle. This is what we're going to be looking for when we take our trades. Okay, this is a prime example of an inefficiency being filled. This candle here reached down to there. This one opened there, reached up a little bit, and then pushed back down again. So we've got between the candle open or high on this candle and the close on this candle, we've got an area where price didn't trade. What happened in the following candle? It reached up, filled this inefficiency in, and then decided to carry off in this direction. And remember this inefficiency we spotted a minute ago. Look how price came up and just filled it before carrying back on down on its merry way. All right. So this is obviously a prime example here. Massive inefficient candle. That whole area there was only traded in one direction, up. Green candles all the way. Okay, never got a red candle in there. So what's price going to do? It's got to come back down and fill this area completely, which it does. in this section here. Okay, so these are imbalances, imbalanced candles that we can look for when we're trading. So let's take a look at a live example right now of an imbalance in the market. So I can see one right now here between this candle's low and the high of this candle. This area here has not been traded in. Okay, so this is an area the market has shot through and hasn't managed to fill in. Now we're doing this on the 15-minute chart, and sometimes these can take a long time to fill in. But what we're going to do is just quickly scroll forward in the chart and just see if price comes back up and fills in that efficiency. Okay, so let me extend this out so that we can see. Okay, let's go out a bit further. Okay, so that's where the inefficiency is, around about there. Okay, if we extend that along, we can see price has come back up and filled that in. Let's zoom out a little bit so we can see it clearer. Okay, so there's our inefficiency, our propulsion candle that didn't get traded back into. And look what price did. Came back up and made sure that that was filled. And look at what we've created here. There's loads of them at the moment because we've just had some big news. But between that down candle there and let's say that up candle there, this whole area, we've only ever had buys. Okay, if you want to be really targeted on it, it's probably going to be that section there, which is going to be the imbalance in the market. Okay, so price is going to come at some point back down to this level. Now, how can we use this to our advantage? Obviously, we can see when we get these propulsion candles that price tends to come back and fill them in. So our expectation right now on the US dollar yen 15-minute chart is that at some point price is going to want to come back down here and fill this gap in. Okay, the problem is we don't know when this is going to happen, how long it's going to take to get there. All right, but we do know there's a high chance of price coming back down and filling this in. So our bias on this pair at the moment temporarily can be short because we're expecting price to come down here. So we should be looking for short opportunities in the market right now. If you look back at the previous one we spotted, which was here, and look how long it took. So this was the 11th, the 4th of November. This didn't fill until the 9th of November. So these can take many, many days to fill in. But this one here, this big propulsion candle here, was filled in within a couple of hours. All right. So these imbalances become key areas that we're going to look to target when we take a trade. So every time we see one of these form in the market, which will typically be around news in the market, so news that comes out on Forex Factory, forecasted news, unforecasted news. In this case, this was the vaccine being released for the coronavirus. That made a massive spike in the market in lots of pairs. So every time we see these, we can mark them and use them as targets to trade back to in the future. Now, the shorter the time frame, the more of these you're going to spot. Okay, so you're going to see more and more of these inefficiencies drawn on lower time frames, and obviously as you go through time, these will take any amount of time to get filled in. Okay, so what I'm trying to say is, if you're a short-term trader and you're taking long opportunities down here with a view to this being filled, this could be part of a much larger propulsion candle on a higher time frame. So if we go up to something like M15, that's still there. M30, okay, you can see actually this propulsion candle is a lot bigger on M30. H1 is the same, right? So you can see how as you go up through the time frames, the longer it's going to take it potentially to come back and fill these gaps. So personally for me, when I'm looking for imbalances, I like to use the H1 time frame or H4. So if you can mark these out on an H4 chart, okay, they tend to be much more stable, I find, targets to aim for. Okay, so when these moves, these big moves happen, the higher the time frame you are, the more likely they are to be filled, and the easier it is for you to see entries to fill them. On the 5-minute charts, you're going to see loads and loads of opportunities, bearish engulfing candles, hammers, shooting stars, breakers if you're using the order block breaker indicator. There's going to be loads of opportunities for you to trade in that direction, but because the lower time frames have a lot more chop, a lot more up and down movement on them, you're going to get stopped out a lot more. Okay, so what I want you to do is concentrate on looking for these propulsion candles, these imbalances in the market, initially on the H1 or the H4 charts. And when you're taking your trades, which we're going to discuss later on in another module, we're going to be looking to see if there is an area of imbalance that we can use as a target to trade back into. Okay, so these are going to be key to the success of our trading strategy. Bullish engulfing, move back up, fill in where it hasn't, it's touched the imbalance, didn't quite fill it in, moved away, came back up, completely filled the imbalance, pop back the other direction. Okay, so that's imbalances or propulsion candles. Okay, and that's to do with the efficiency of the market, the fact that the market likes to trade in both directions, have buys and sells to fill as many orders as it can. When you get large candles or large moves in one direction, usually a large dump of orders from a big bank, those voids, fair value gaps, imbalances, propulsion gaps, whatever you want to call them, those are the targets that we're going to aim for. A lot of people in the Telegram group have said to me, how do you get such a high strike rate? And how do you know the direction that the market's going to go? Basically, 90% of my strategy comes down to looking for these and spotting good ones in the market when I see a good price action candle or some kind of condition that has been met. All right. So these are very, very, very important, and it's important that you understand these and practice finding these in the market and seeing how price will always come back to them at some point. The problem with them is we don't know when price is going to come back. We know it will, we just don't know when. And this is part of the issue with getting into the market, which hopefully I'm going to help you overcome in later modules as we go through the course. Now I want to quickly cover balance and imbalance in the market as a whole. So we know the market moves from areas of balance to balance, and in doing so it creates areas of imbalance. So balance is consolidation, imbalance is the move from consolidation to another period of consolidation. We can use these as target areas as we expect price to come back and trade in these areas at some point. We know that. We use these waves, these fluctuations, to anticipate and follow where the market makers are likely to take price. And this is based on historical data and analysis of how the market moves. So it's factual data, not a kind of crystal ball or holy grail type thing we're looking at here. We can look left on the chart at any time if we zoom out into higher time frames and see where these areas of balance are and where they've been, and anticipate them moving back to these areas again in the future. Okay, so we're using probability here and creating a statistical edge by knowing where price is likely to move from where it currently is the next time it goes from a level playing field in consolidation or imbalance into a new area of consolidation and imbalance. All right, so let's have a look at how price moves and see how we can spot these areas basically. So I've just got a chart up here. Okay, we're on H4 at the moment, so I'm just going to draw in some areas of balance on the chart here just to demonstrate what I mean by areas of balance and imbalance in the market. All right. So this area here, we're going to start here on the left hand side. I would class as an area of balance. All right. So price has traded up and down in a consolidation here for quite a while. All right. Then you can see that we had this big push up into another area up here where it kind of traded up and down for a while as well. And then it pushed up again and found a new area to sit and consolidate for a bit before finally moving back out and finding consolidation again at this sort of level. All right. So what this is just an area of consolidation. Now these consolidation areas can take the form of really long, wide sections of the market like this one. I mean, this is a big area of consolidation here where it's just moved up and down and up and down. It's balanced because people are buying here, they're selling here, and it's ping-ponging between these areas of a range where it's quite happy to sit and trade until somebody says, actually, I want to take the market in a different direction. All right. So what we'll find is that as price moves from these areas with these big propulsion candles into a new area where it's happy to trade, and again, it will tend to move back to the areas it's visited before. So this area here has an overlap with this new area of consolidation. All right. So when we're up here and we see price moving back down to here, we know we've got two possible directions we can go from here. Yeah, it could either go that way or it could go that way. Because we haven't got anything up here recently apart from this area that we can see to the left, what we're more likely to do is move back down to the area we've just been to previously. So this is the area of balance that we had previously. Okay. Now as we're trading through this consolidation zone, nicely balanced and everyone's happy trading up and down through the zone, we see price move back out again. And what does it do? Retests this previous area of balance before moving back down into this previous area of balance. And then it rejects that and moves where? Back up into another little consolidation zone in the area it's just been trading at. And then it moves back up again, sits and consolidates, back down, sits and consolidates. This whole area you can probably class as an area of balance, isn't it? More like this. That's the area of balance there. And look how this area of balance and this area of balance line up. Okay, this is consolidation and price returning to previous areas of consolidation or balance that it's been to before. All right, so that's just a quick demonstration of how the market moves from area to area. You can call these zones, some people call them zones, but basically they're just areas where the market is happy. It's happy to keep a consolidation before deciding it wants to move off into another quick move into another area where it's going to sit, move back, test somewhere, move off again. So it's just the areas where we're sitting waiting for something to happen. Okay, and this is going to tie in nicely with the 3 times ADR push and levels theory. Okay, so you're going to see a lot of consolidation zones within levels theory, which we're going to cover next. Okay, levels theory and the 3 times ADR push. Okay, this is a theory which was developed by, I think it was developed by Steve Miller, I'm not sure, but it's certainly something that he has taught in the past, and it's basically revolves around the fact that the market moves in a cycle, And this cycle is either a 3-day, ideally, in a perfect scenario, or a 3-level cycle. Now this is a bit more of a loose strategy, as I call it, because often it will play out, you'll see it, and it will be clear as day, and often you won't be able to make it out at all in the market. And this is something I really struggled with when I was trying to understand levels theory and how the market moves, because I could see it occasionally and other times I couldn't see it, and it just stopped me entering trades because I was looking for these levels and I was trying to make these levels fit onto a chart where it just didn't fit. So I ended up kind of dumping it, but what I've discovered as I've been trading more with order block theory and market structure and order block breaker theory is that the thing to take out of this is where the peak formations have formed. All right, I'm going to explain and show you a little bit more on a chart in a minute, but this is often known as what's called the buy model and the sell model. Okay, the market makers are moving price in their favor until they need to get to a level where they reset, okay, and they build a, that says budge, but they say they build a big enough book to move on again in another direction. This is a large consolidation area, an area of balance, okay, but this plays out over days and sometimes over weeks. So it's the longer term move or market structure that the banks are using to their advantage to move price, take profit along the way, and then reset with a view then to taking price off either in a positive, in a northerly direction or a southerly direction, depending on what they want to do. Okay, this isn't an exact science, as I've said. Sometimes price will move in 3 levels, but sometimes it will move in 4 or 5 or 6 levels. Okay, we don't know for sure when these levels are going to stop. So it's open to interpretation, which means that I will possibly draw these levels in differently to you. So if I teach you this theory and say, I want you to go and see a chart and I want you to draw 3 blocks on it from the bottom to the top, you might draw those in differently to me. Okay, so this is something you need to look at and interpret in your own way. But don't worry too much about it if you don't want to use it or don't understand it. The dashboard has a peak formation high and a peak formation low column, which signals when this 3 times ADR push is complete or should be complete. So it's just a thing to look at as confluence when you're looking to take trades, okay? But what I will say about this is the way that I trade with a loose stop and a scaling in type entry method, it takes advantage of this 3-level push theory all the time, okay? So I use it as an extra reason to look for trades and to get into trades, okay? It's the theory of what goes up must come down, all right? So price is expected to consolidate. Let me just get a bit of a thicker pen here so we can see it. Price is expected to consolidate and then push in 1, 2, 3 moves before finding a peak. Now at that peak, it's got a choice. It can either consolidate and then come back down in 3 pushes, consolidate again, or it could just drop straight down. Okay, that's the theory. Okay, the problem is it doesn't always happen in 3 moves. Okay, 1, 2, 3. Okay, it doesn't happen like that every single time. And that's why I say don't pay too much attention to it. If you get lost in this bit, we don't need to know about it that much, but it's something that you need to be aware of. Now the other thing that can happen is market will move up in its 3 moves, consolidate, and then move up again. And it will go further up. So what it's actually doing is moving up 1, 2, 3, sitting around, 4, 5, 6, sitting around. So the 3-level theory, the 3 times ADR push, is still true. It's just it didn't come back down. It went up. All right. So, but the thing to look out for is this consolidation area. What it does is it moves up 3 times, and then it consolidates. Okay, remember the market makers, the banks, they're building their order books, ready to take price off in another direction. That's what it is. So let's have a look at this on a chart and see if we can identify some 3-level pushes for you. So what we're going to do is I'm going to draw the ADR of this pair as it stands at the moment. Okay, so the ADR of this pair, the US dollar yen at the moment, is 86. So we're going to draw a box which is 86 roughly pips high, which is there. Okay, and I'm going to create 3 of these. And what we're going to do is we're going to use the H1 chart. How have I put those order blocks over there? Let me draw them again. It's not a very good place to draw them. Okay, so let me just draw one here, 86. Okay, that's roughly 86. Second one and a third one. All right. So theory is, let's say this is the peak formation high. So price has moved up. Actually, that's probably the peak formation high up there. Oops. So theory is that from this high here, which is the highest point it's recently put in before it made its move down, price should move 3 times the ADR. Let's get to that one. Okay, so it should come down to that level. Okay, what did price do? Move down, back up again, down, back up again, down, pushed up again, down. And look what happened when it got to roughly 3 times its ADR level. Consolidated, and then bang, push back up the other way. Right? So that's the theory. Now you will find lots of instances where price will use 4 times its average daily range before it puts in a consolidation and a reversal. You'll also find instances, as I said, where it will move 3 times ADR, put in a consolidation, and then crash back down again. All right? But the theory is that this is the market makers or the bank's sell cycle. So what it's doing here is it's gradually selling all the way down, okay, 3 times the ADR. That's where they take their master profit, if you like. So this is where they've got everything they want out of these sells. Now, what they're doing when they're selling all the way down here, if they've done it efficiently, they're now left with a load of longs. What they've got to do now is get rid of these longs. How do you get rid of longs? You sell them. But I don't want to sell these longs at a loss, because all the way down here I was accumulating long orders. So what I want to do is take the market back up and start selling on the way up here. Okay, so what the market's going to do is it's going to go into a sell cycle with 3 pushes, consolidate, and then move into a buy cycle with 3 pushes. That is the levels theory and the 3 times ADR push theory. Okay. Now the reason, as I said, if you don't want to concentrate on this as a theory and use it in your trading, you can live without it, because you will start to get very lost and confused when you start trying to figure out how to put this into a structure. So we've got a clearly defined high there. Okay, I'm just going to pick this at random. I've no idea what this, how this is going to calculate, but so that's our 86 pips roughly. So if we put that up to the top there, duplicate it down 3 times, I would be looking for price to move down to that level, all right, before it starts to reverse and go back in the opposite direction. Look what happened. We got down another 1.5 ADR. So this one went to 4.5 times its average daily range before it started pushing off back in the opposite direction. Okay, we've got a peak formation low clearly defined in the market there, this big strong up move, so this was a definite move to the upside. So this one, 3 times ADR, would take you up to there. Look what happened. Consolidation. Push back down the opposite way. All right. But this push back down the opposite way from this peak, if we look at the 3 times ADR theory, should have got down to here. But what happened is it only got down to 2 times ADR, popped into the 3 times ADR range, and then it shifted back in the opposite direction. Okay, so if you want to swing trade, this is a fantastic theory to start with. The problem with the theory is when you get in, right, you have to make sure that you know this is the peak formation high. You could have thought that was a peak formation high, got in there, got stopped out, consolidated, went your way. Ugh, not again. Okay, the only way you know if for sure that's the peak formation high, and you don't know for sure, but what will confirm it is when you get a break in market structure. So you would get a breaker forming here, and you can see price has already put in 1 times ADR. So 1 times ADR would be this level here. Okay, so when price breaks through that, you can be pretty sure that's the high, and if you get in somewhere around here, you know the good target to aim for is down here. The problem is price will come up and try and stop hunt you all the time. Okay, so you got in here, for example, or let's say you got in on this candle that came down here, you would have put your stop somewhere around there maybe. Look what happened. Bang. They knew you'd gone short because it got to 1 times ADR. They know what you're doing. You got short. They took it down a little bit. You didn't take your profit. You got out. You're now sitting at break even. Went down again. Yeah, this is the one. No, it didn't come out. Didn't get down to the 3 times ADR. I'll wait. Comes back down. Takes out your stop. Bang. Hits your target. Okay. So 3 times ADR theory is useful. It does play out quite often, but quite often it doesn't. And for me, it's not something I want to use as the basis for getting into trades, but you need to be aware of it. So the way I use this is if price has exceeded 3 times its average daily range, okay, from the last peak formation high or peak formation low, as these are called, the peaks of these swings, what I'm going to do is start paying attention to the possibility of a consolidation forming and then a move back in the opposite direction. Because typically what the market makers, the banks, will do is they will move price down and then move price back up. Move price down and move price back up. And what's happening is you start getting into a very big range. These pushes where they go 5 times ADR is basically them breaking out of a range. Okay, so if you expect price to normally go 1, 2, 3, consolidate, 1, 2, 3, consolidate, 1, 2, 3, 4, 5, all that is a breakout. Okay, and then we would expect price to come back up, retest this level before continuing down on the new trend. All right, so that's levels theory. That's the 3 times ADR push. That's all I want to cover on that particular part of the section. Sorry if it hasn't been 100% clear. This is quite a deep section, and it's quite difficult to explain in detail, but hopefully it gives you an idea of what happens in the market, why the market moves, how it moves, and how these moves we can identify them and use specific parts of them to create targets for our trading and entries for our trading positions. Okay, homework. So what I want you to do tonight, or whenever you're watching this video, just spend a couple of hours drawing some lines on some charts. Okay, so we're just going to get used to looking at the levels we've discussed and how stop hunts work, how price reacts around price levels that it's visited before. So have a look at some H1 and some H4 timeframe charts. You can use F12 to step forward through the charts, or just scroll through the chart with your mouse wheel, or however you want to do it. And just see what happens when price gets to these specific levels, how it bounces from levels, how stop hunts work. See if you can find the stop hunts. See how it shoots through price at some levels and doesn't respect it at all. Draw in new lines as you're scrolling through the chart, and just keep stepping forward and studying what price does at specific levels when it hits peak formation highs and peak formation lows, turning points in the market. These are key support and resistance areas. I'll show you how to do this in a second, just so you've got a better understanding. After you've done the H1 and the H4 exercise, drop down to M15. Have a look at what price does during the Asian session. Have a look at how stop hunts happen at Asian highs and lows when London kicks in. Look at how yesterday's highs and lows tend to get raided on a regular basis. And also the highs and the lows from the previous days also are usually good reaction points for price to turn at. Look how small the Asian range is, and see how it's just a consolidation area for the market makers, for the banks to build up orders and then take price off in the direction they want. Look at how London reacts to sweep the Asian levels and moves further to find new areas to go and raid stops at, to build up more power to make further moves. And look at what happens when New York kicks in, when the New York session takes over from London. How does it continue London's trend direction, and how often does it trade back in the opposite direction? Okay, so look for patterns that repeat through the Asian, London, and New York sessions over and over again, and give yourself confidence that these stop hunts are happening on a regular basis. Look at the H1 charts. Draw in some levels of 3 times ADR moves, which we've just covered. Just see if you can draw in some boxes and see if you can identify the 3 level pushes. I left this to the end. If you don't want to do the 3 level pushes, don't worry too much about it, but just try and measure and see how price moves away from peak formation highs, how far it moves before it turns around and comes back in those buy cycles and those sell cycles that the banks tend to put into play. So let's have a look at how to draw these lines on the H1 and H4 chart at peak formations, so we can see how the stop hunts are happening. If you've got the order block breaker indicator, there's one quick trick you can do where you've got the number of breakers to show. You can increase that to a higher number, and that will basically draw more breakers back on the chart. So you can scroll back and you can see where there have been previous breakers before. But basically all I want you to do is just scroll back in time and have a look at it doesn't matter where you start really, I'm just going to go back to around here, and just start drawing lines at the highs and the lows. So that's a peak formation candle there, so it's the last candle that made the peak after price made this big up move. We've got a peak formation low formed there. Okay, so price moved down, put in another low here. We've got another peak put in there. We could draw another line in on this one here, and maybe that's probably about it for that. Obviously we've got this peak here as well. So you see how price moved from this low all the way up to this high. It then pulled all the way back down, put in a new low, put in a new high, dropped down, stop hunted this level here, push down. Well, if we scroll through time now, we'll see how price is reacting at these black lines that we've drawn in, these levels. Okay, so you see how price has come back up to this level here, little peak above it. What's that? That's a stop hunt. Anybody that entered in a short position here would have put their stop just above there, and they'll be trapped in this consolidation period for days on end, going absolutely nowhere. So before the price is taken off in one direction, they come up, they take these stops out, move off in the opposite direction. Okay, you see price playing out. See now it's moved all the way down here. So anybody that was short up here, it's gone in their direction, but they got stopped out. All right. So we could draw in another line here at this low. See how price comes down to it, moves back up, comes back down, moves back up. Okay, this was the previous high. This one's a stop hunt again of this level. So look at this level here on that very top peak. Okay, it just peaked above it, stop hunt, pull back down. Big move up. This is a big stop hunt. If we scroll out and have a look at where that one's happened, this one here, okay. Anybody that's entered long, short here, or maybe got in here, because they've seen this big down move and they're anticipating a further move down, they just got stop hunted. All their stops above here, this area here, raided, and then price taken back down in the opposite direction. Okay, this level here, this black line here, which was this peak formation low, okay, raided. Actually, it was this peak formation low here, wasn't it? This one here. Okay, so anybody that got in along here, raided. Back up again, up to this level, raided. These guys move back down. So just see how price reacts around these levels and how they act as turning points quite often for price as price moves through time. And the thing you need to bear in mind with stop hunts is, because the market has different time frames which people trade on, you're going to find different levels on different time frames. So if we come up to H4, okay, you can find a level there, you can find a level there, and you can find a level up there. Okay, and you can see how price sort of reacts at these levels on H4 when you go down to the H1 time frame. Okay, nice consolidation around that level there. So just basically put some lines on the chart, have a look at how price reacts when you see a high or a low formed, ideally peak formation highs and peak formation lows. So this is just really a support and resistance exercise. We need to get you to look at levels and just understand that these levels are raided. Okay, they get raided, which is a stop hunt before price shoots off in the opposite direction. So these are prime areas that we want to look at getting in to trades at. Okay, then drop down to M15. All right, and on your M15 charts, I'm just going to scroll in. Let's go to the end of the chart. You'll have the Asian session, the Asian session, London session, and New York session on your template, hopefully. And I want you just to scroll back as long as you can. Find the beginning of the sessions indicator. That as well, I think you can change the number of days. Yeah, so mine's set to 30, which is the default on here. You can increase that and go back way further if you want to. But just look at how in the Asian session, price tends to, CAD Yen's probably not the best pair to do it on. Any Yen pairs, New Zealand pairs or Aussie pairs will have price movement quite often during the Asian session because they're Asian session currencies. But just have a look at how price moves on the Asian session, the London session and the New York session. See how there's quite often a tight consolidation before a move in London and then what New York does with price. Look at levels, look at yesterday's highs and yesterday's lows and see how they get raided. So there's this blue line here is yesterday's high, which was yesterday's high of London. See how in Asia it peaked above it, stop hunted it, and then price moved down. Look at how we got yesterday's low from the New York session here in Asia. Price moved down, raided it, moved back up again. This is probably a better exercise to do on a non-Asian pair. So let me just switch over to, let's go something like pound US dollar. Where are we? Okay, so in a pound US dollar pair, or euro US dollar, or euro US dollar, US dollar pound and euro based pairs, you're going to get much more consolidation and much more movement in the London and New York sessions. So if you look at how price consolidates here in Asia, beautiful stop hunt to the high of the Asian high here, and prices moved back down. Okay, Asian session, stop hunt to the high, back down. They also raided the lows here as well. So if anybody had seen this move going to the high, they would have put a stop underneath the Asian low. London pulled it back, stop hunted it, pushed it back up again, encouraging people to take a long here. New York pulled back, took the stops out below there. So in this day, basically, they raided the stops twice before taking the price off in the direction they wanted. Asian session, consolidation, moving up to here. London takes it above the Asian high, stop hunt, push to the low. Okay, Asian session, stop hunt at the high, and then pull back, push off in that direction. Okay, Asian session, London raided the top, stop hunt, pull back, stop hunt of anybody that went long here because they would have put it under the Asian lows, move off to the highs. Okay, so just go through and look at how tight the Asian range normally is, what happens in London, and how often London and New York trend in the same direction. You quite often find whatever direction London's gone in, it will reverse sometimes in New York. So just have a look at how price moves. You want to get you're used to seeing what happens during the sessions on the lower time frame, especially the M15 charts. Okay, and then you can switch up to H1, and on H1 just try and do some order block theory. Got the ADR indicator on here. If you've got the dashboard, there's obviously on the dashboard we've got the ADR column here, so you can see what the ADR currently of a pair is. This doesn't change a huge amount. You do get fluctuations when you get big price movements due to fundamentals and news, but typically the ranges are always pretty big on the pound pairs and pretty small on others. So these are typical ranges. You can use these as a kind of average if you like. So just try and draw in some order block theory. Just draw a box. If you double click on the corner or the center of the box, you can then resize it. You can see there the right hand number. It's 139 I'm looking for on this one, which would be 1390. Okay, so 1390, got a peak formation high there, so you can duplicate a box by holding control on your keyboard, double click, hold control and duplicate it. So you can do this exercise basically to measure peak formation high. So this one has just been put in here on the pound US dollar. Okay, if I'm using the 3-move theory, okay, and I'd taken a short on this breaker here, okay, stop goes above here, I'd be looking for price to get down to somewhere around this level if the theory holds. As I say, this is a little bit more of a woolly theory, but the 3 times ADR move is, for me, something to trigger an alert. So this actually is a good example I'm going to quickly show you. That is the peak formation low. Okay, we've got a breaker here. We've moved away from that. We haven't put in a new low, so we can confirm that this is definitely the peak formation low there. Let's do a 3 times ADR block here. Okay, so that is 3 times ADR, and look what price has done. 1, 2, 3 ADR pushes, big stop hunt to the high of anybody up here that took any shorts, and we're moving back down. So when price gets above this level, above 3 times ADR, the dashboard is going to tell me that. It's going to give me an alert. It's going to color this in and show me that price has moved above its normal ADR level. Okay, and that tells me to pay attention because I'm possibly looking for a reversal. So I didn't get in this one today. I'm already in some pound trades on the euro pound and the pound yen. So I only take 2 trades, which is something I'll cover as well. But that's a prime example. Okay, so that's your homework. Go and have a look at some charts, draw in some levels, try and look for stop hunts, see what happens on these levels when price gets to them and reacts. Draw in some ADR boxes and look at the London, Asian and New York sessions and just see what I've described to you as the banks are doing on a daily basis playing out on your charts to give you some confidence that you can see this actually happening.